It's a good reminder as well that we give, we keep talking about, we have time, treasure, and talent, right? And so when we give of our time, we give of our treasure, we give of our talents. There's again this integrity, this integer, this wholeness of who we are, what we consider and how we give. So thank you. All right, we're going to look now at going back to these financial blocks, these building blocks of management. Let me just make sure, is everybody seeing my screen okay? Because I'm doing something new on my side. I don't know for sure what you are seeing. Are you seeing the full slide?
Yes.
Yes.
Okay, perfect. So the building blocks of financial management, we had said that there were 4, right? And so we looked we will be looking a little bit at the accounting records. Last time we did that, and that's really the cash journal that you did, where you're writing your income and your expenses. We looked at financial planning in terms of budgeting and how to do budgets and the importance of doing budgets. We will be looking at internal controls on Friday. And so today we're going to look at the financial monitoring. And so as we take the records that we produce, which should be then based on the budget, now we want to figure out how do we monitor these things. And in order to do that, we want to look specifically at nonprofits, or non-governmental organizations, and churches fall into that type of a category. They are not a business. The NGOs operate differently than businesses and churches as well. And so there are 4 features that connect nonprofits or NGOs and voluntary organizations. The first is that they exist to fulfill a charitable purpose. Right? And so the purpose of the church, the purpose of an NGO is to fulfill some sort of charitable purpose that has been identified. The second is that they function without the use of coercion. All right, people are supposed to be able to come voluntarily to your church. They are to come voluntarily to a ministry. Third, they operate without distributing profits to shareholders. And that one is very important. That's a critical difference, right? Sometimes people get offended when they say the church operates like a business, but in many ways, churches and nonprofits, NGOs operate similarly in that they have to do bookkeeping, in that they have to take care of staff and have a personnel policies. They do some marketing, whether you acknowledge it or call it marketing. When you are advertising your church or programs or ministries, it's marketing. So there are a lot of similarities, but the key difference, other than the purpose of the existence, is also that profits do not go to shareholders. And so whatever a church or an NGO earns above, it doesn't mean that they can't charge for services. So if you have an NGO that offers a training, they can charge for that, and they can even make a profit on it, but the profit stays with the ministry to maybe help in other areas rather than being taken home by the CEO. And then the last is that they exist without simple and clear lines of ownership and accountability. And that is the most problematic one, right? And so who owns the church? God owns the church. Well, that's very true. But on earth, who owns the church? Do the people own the church? Does the denomination own the church? Does the elders, does the council own the church? And so it's not as clear. It's more ambiguous than it is with a business, where it's very clear who is the owner of the business. And so those are the 4 features that we want to keep in mind as we think of churches and of nonprofits. Because if we know who owns the church, then we also need to know the stakeholders and who do we report to, and where does our responsibility lie? Even for businesses, we say, essentially it's, you may own the business, but the customer is number 1, because without a customer, you don't have a business. And so for the church and for ministries, again, those that we are seeking to serve become the people that we want to be transparent and accountable to. There's 2 types of cash systems or accounting systems that you may be using, and one is called cash and one is called accrual. The simplicity or the complexity of the accounting system depends on the size of, here it says NPO, which is a nonprofit organization, or NGO, non-governmental organization. Size of your church might depend on that. It might depend on the legal environment that you are in. It might depend on the tax authority and its guidelines, or the reporting requirements of government and donors. So two main systems, and we want to look at that. The first is a cash-based accounting. And in my experience, many micro businesses, small businesses do a cash-based accounting. My guess is most churches do as well. And it's the simplest one. It means that transactions are only recorded when cash is received or when cash goes out. All right, and so the terminology you might have are cash receipts and cash disbursements. So you don't record a transaction if somebody gives a pledge for a building fund. You don't record it until that money is actually received. You may make a purchase of something, and for the church, you may buy some new instruments and say to them, I'll pay you later. You don't record it until the cash is actually dispersed. So it's only accounting actual transfers of money coming in and money going out. Very simple, cash-based accounting. The second one is accrual-based accounting. And this usually goes according to the general accepted accounting principles, which require this. And the terminology that is used for accrual-based accounting are revenue and expenses. Revenue is essentially the money coming in, but it is broader than that because it recognizes when that money is actually earned, not when the cash is actually collected. So in a business, you might say you make a sale of something and somebody says that they will pay you later. In the cash system, you would not recognize that until that money comes in. And so it's not acknowledged. But in an accrual system, you acknowledge that sale when it happens, even though the people may not pay you until later. So it becomes an accounts receivable. It's money that you expect to receive, and it counts as part of a revenue. And we also use the word realizable, when we'll really be able to turn the real receivable in the future into cash. And so the same as with a payment. When let's say you buy those musical instruments, you record that you now have this liability. You said to the people, I'll pay you later. No cash is left out, but you record it as something that you will need to pay. Okay, so two types of accounting systems. You will know for yourself which type you're using based on these descriptions. Cash, very simple. You only record what actually is happening. Accrual is looking at revenue and expenses when they happen, not necessarily when cash is actually transferred. So the time of the actual cash receipt or the disbursement does not determine in which accounting period a transaction is recorded. And so that's part of the accrual counting system. So for example, you buy the instruments, the musical instruments in June. You don't have to actually pay it until August. So, but you record the equipment that you've received. That becomes an asset, something that you own in June, and you also record the liability in June. And then in August, when you make the payment, that's when you will reflect it in the cash going down and the liability then being cleared. And so accrual-based accounting, you're recording what happens as it's happening, whereas the cash system, you're recording what happens when the cash actually moves. And so accrual is a more complete picture. It involves a lot more details than the cash alone. And it also helps you keep track of those accounts receivable and those accounts, those liabilities that you may have. All right, so let's go over we're going to go through the 4 major financial statements that we would like you to consider having, or maybe you already do for your church or for your ministry. And so the 4 major financial statements for NGOs are, the first is a statement of financial condition. And if you have gone through the SME training, or if you've done business training, that's essentially the same as a balance sheet. NGOs or nonprofits like to have different words than business because, business is more profit and loss oriented. And so we just call them slightly different names, but they still essentially are the same thing. So statement of financial condition. The second is a statement of activities. And again, in the for-profit world, that would be an income statement. So what is the income coming in? What are the expenses going out? That's basically your statement of activities. The third is a statement of functional expenses. I'll show this to you. Not many people use it, and I'll explain why that is. So as far as I'm concerned, if you want to forget about it as soon as I've talked about it, that's okay. And then the last one is a statement of cash flows. And so how do we keep track of all the cash flowing in and out? So that's what we're going to do, is to go through those 4 different reporting in order for us to have good financial management. Let's look at a few terms just to make sure we're all on the same page. When we talk about assets, we have current assets and we have fixed assets. Current assets are those assets that are cash or can be quickly exchanged for cash. This means that they are more liquid in nature. They're not fixed. They're more liquid. So obviously one current asset we might have is cash, any cash that the business has. Accounts receivable would be any money that is owed to the business by the customers who have established credit accounts with the business. So again, this is an accrual system that we're going to be talking about. In the accrual system, if somebody pledges money for a building fund, it's an accounts receivable. If you make a sale and the person hasn't paid, that's an accounts receivable. It's money that you expect to be able to turn into cash. It's an asset. Inventory that you have. So what are the goods on hand that might be owned by the business or by the nonprofit or by the church if you are selling t-shirts or selling calendars or different things. Prepaids are another asset, and that is something that we often forget, but it's, if you have paid for something in advance, it's an asset. And so if you pay rent for a year in advance, you need to recognize you're only 2 months into that year. You still have 10 months of rental, a rent that has been paid. That is an asset. Phone cards, again, if you load your phone up with scratch cards and you haven't used it, that's an asset. And then there may be other assets. Not everybody has all the same assets. These are some examples that you may have. Fixed assets now are those assets owned by the organization that cannot be turned into cash as quickly as current assets. So example would be the equipment that you have. And a lot of this is what's going on to your balance sheet. I'll add up all the purchase price value of the equipment that you own. So what does the church own? What does the ministry own? What is the purchase price value? The land, if the organization or the church owns land, what is the current value of the land? If you don't know it, then put in the purchase value. If you do know it, then you need to just back up how you came up with that number. Building, if the building organization owns a building, what was the value of the building at the time of construction or at the time of purchase? And then you have the allowance for depreciation. So understanding that, let's say we have some musical equipment. We've owned the keyboard for about 5 years. We bought it at one amount. We expect it to last maybe 10 years. So now we are going to divide that amount by half as to allow for depreciation, so that we are showing an accurate value of what the ministry owns, what the organization owns. And so except for land, evaluate the fixed assets, determine their present value, subtract this amount from the original amounts listed as the original value, and then the difference is the allowance for depreciation. Terms that we want to make sure we all understand. Now, when we talk about NGOs or churches or nonprofits, we have to recognize that there are 3 additional categories of assets that are very critical. And this is where accountability and transparency comes in. In nonprofit management, financial management, there are 3 different classifications that are used for gifts that are received. One is unrestricted net assets. Second is temporarily restricted net assets. And the third is permanently restricted net assets. All right, and so these 3 classifications are from the donor's viewpoint. So churches receive gifts and offerings, right? Ministries receive gifts and offerings. And so when the donor gives something, it typically falls into one of these 3 areas: unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets. I just killed a mosquito, and I'm in Michigan, and it had blood in it, just so you know. All right, unrestricted net assets, what are those? Sorry, Ellen, you're laughing at me. Net assets are not temporarily or permanently restricted. And so unrestricted net assets is when somebody gives a donation and they don't say anything about how that donation is to be used. They just give a gift, all right? And so usually tithing is unrestricted. They're not saying they want it for something specific. They're just giving it to the church, all right? An offering might be more restricted. If you take up an offering for the missions fund or the building fund, it's expected by the donor that that money will be used for what was intended when the request was made or when the gift was given. And so that's a temporarily restricted net asset, all right? And so I would give, let's say, to the children's ministry or to the building fund, and you don't have the right, if I give it for that purpose, to take it and to put it somewhere else. All right, it's called a temporarily restricted net asset, and you are attempting to restrict or to honor what it is that the donor intended in giving that gift. And so that is very important, and that's a lot of ways actually where people lose confidence of givers, when they arbitrarily make a decision that this need is more important and they disregard the intent of the giver. Now, that's where you have to think through your own policies, because sometimes you may actually have a legitimate, something happens and there is a need. And there are ways that you can communicate with the donors, that you can put some clauses in to help understand that there's a problem with that. And one example I like to give is the earthquake that happened in in Haiti in 2009. And there was so much, the world just responded incredibly and gave so much money for this earthquake in Haiti, to the point that people had not set up these clauses that said, if that money is not needed in Haiti, we have the right to put this to other projects or other programs or other needs. And so the ministries that received that money were compelled to give it to Haiti, to the point that they essentially destroyed Haiti's business environment, because so much free stuff came for so many years, businesses just shut down. So you do want to have some sort of clauses in there to give you permission if you have a need to move it, but for the most part, you want to really respect the donor so that they can maintain faith that if they give for the building fund, that building is actually going to be built. If they give for the children's fund, that money will actually get to the children, and so on. The last one is permanently restricted net assets, and this one doesn't happen very often, okay? That is when a donor gives, one common example is an endowment fund. So if you run a Bible school or a seminary or a university, you may have somebody that gives you an amount of money and then instructs you that you may never touch the principal, you may only give from the interest. And so that is permanently restricted net assets. Most of us don't deal with that. And so you would have to ever seek permission from that donor to touch the principal, but you may use the interest for whatever the specified purposes were. So those are the three net assets, and those are things that we need to keep in mind for nonprofits, that we understand, excuse me, which are unrestricted and which are temporarily restricted. All right, so that's it for assets. Then we go to liabilities. These are short-term debts of the organization that are typically due within a year. Those are current liabilities. We also have long-term liabilities where it goes beyond a year. Some liabilities that you may have in your church are accounts payable. People or entities to whom the organization owes a short-term debt, less than a month, and often an amount that is due by the end of the month. And so it may be today's the 24th of June. You may owe your staff salaries for the month of June. You'll pay it at the end of the month. Right now, that would be an accounts payable. You may have to pay for electricity. So you need to know that those are some things that you owe. You may have accounts payable that you pay, you get some things on credit and you pay within 3 months, those types of things. Long-term liabilities with anything owned by the organization that usually has a signed agreement to pay over a period of time, usually more than a year. So this debt cannot be called upon to be paid all at once. So if you have a signed agreement, it restricts the amount that the person that you owe the money to can claim, and it's usually set up with an arrangement. All right, so let's go now to the first report that we want to look at for a nonprofit, and that is a statement of financial condition, or essentially the balance sheet. And so the statement of financial condition reports the organization's assets and the liabilities in some order of when the assets will turn into cash and when the liabilities need to be paid. The nonprofit statements of financial position is represented by the following accounting equation: assets equals liabilities plus net assets. Now, if you remember this from the business training that we do, we say there that assets equals liabilities plus owner's equity. Again, we said that for nonprofits, there's no clear line of ownership. And so we don't say owner's equity, we say the net assets. And so this is a very important equation. And if you can get an understanding for this, you know, that becomes critical for understanding how your finances run. You don't need to become an accountant, but you do need to understand this equation. And so let's look at this again. Assets equals liabilities plus net assets. What this statement is saying essentially is that your assets that you have, that the church has, that the ministry has, the equipment, the furniture, the money in the bank, you know, whatever the church or the organization owns, the land, those assets can only be explained that you have them in one of two ways. Okay, so you can only have those assets because of liabilities. So maybe you took huge loans, and so you can have all these assets, but you have all these liabilities, and therefore the church doesn't really own it, right? The people that you owe the money to own it. Or it's come as a result of income coming in, expenses being paid out, and we would call that your net assets, okay? So this has come through donations, it has come through money given to the church or to the organization, and so that is actually owned by the church. And those are the only ways that we can explain that assets have come into an organization. So the statement of financial condition, or the balance sheet, is really looking at your assets, and it's looking, and that has to equal your liabilities plus your net assets. So let's look a little closer. Net assets are what belongs to the organization after the liabilities have been cleared. So in order to understand what your net assets are, you can look at all your assets, which isn't that difficult to do, and to come up with a valuation of them. We subtract from that your liabilities, and that gives you your net assets. And this is called double entry bookkeeping, all right? Double entry bookkeeping, it makes some people quiver. I see Elder Johnson there looking very confidently and smiling. You know, this is something that you can learn to become comfortable with if you understand this equation. Assets equals liabilities and net assets, because every time you have a transaction, it gets entered in 2 times. Not necessarily on opposite sides of the equation. Sometimes it can be on the same side of the equation. But we're going to go through a couple of examples on that. But the point is that the statement of financial position should remain in balance at all times. And so we'll look at that. So let's have a donor who contributes $500 to a ministry. The effect on the nonprofit's accounting equation and its statement of financial position is this. Assets now have gone up $500, right? We have cash, that's an asset. So a donor contributes $500, our cash goes up $500, our assets go up. Now, how do we explain $500, this asset do we have? Where did it come from? Is it a liability? No, it was not a loan, it was a gift. And so we explain it by saying that our net assets also increased by $500. And so that's how our assets and the other side of the equation in this case balance out. So I hope that makes a little bit of sense. We're going to go through some examples. So let's talk about a ministry called Home for You. And this is a daytime shelter for adults. So adults who are homeless or adults with some mental illness can come to this daytime shelter. And so it's Home for You is the name of it. And they opened their doors on January 31st. And the first transaction here is that a donor contributes $10,000 without restriction for the operation of Home for You, okay? And so a donor gives $10,000. So how do we show that in our statement of financial position? And you can see there what that statement looks like. This essentially, again, if you're familiar with the term balance sheet, it looks exactly the same as a balance sheet, except that it says statement of financial position and it says net assets instead of owner's equity. A statement of financial position is always done at a point in time, on a specific day, not over a period of time. So this happened on January 31st, the year was 2015. They received cash of $10,000, and so their assets are showing only one asset. You don't have to list all the assets that we mentioned. The one asset that they had was cash, $10,000. On the opposite side, the side that the assets needs to balance with, are the liabilities and the net assets. Liabilities are zero. They don't owe anybody anything. And then they have the net assets. And this is where you would list out for a nonprofit the different types of net assets that you would have. And in this case, it's an unrestricted net asset. The next one would be temporarily restricted net assets. And most of the time, you don't have to include permanently restricted net assets unless you have those. And so they have their unrestricted net assets, 10,000. Total liabilities and net assets are 10,000, and you can see that the statement balances. Okay, so this is a statement of financial position. You're listing all your assets on one side, and it has to equal your liabilities and net assets on the other side. It's done at a point of in time, and we recommend that you do these at least annually. I love it when people do it monthly because I think it's healthier for better transparency. But that is the statement of financial position. The next one is called a statement of activities. And the statement of activities is essentially like the income statement or a profit and loss statement. But again, because it's a nonprofit, we stay away from words like profit that make people uncomfortable. And we call it a statement of activities. Since a nonprofit's primary purpose is to provide programs that meet certain societal needs, it issues a statement of activities instead of the income statement that is issued by a for-profit business. And again, this now takes place over a period of time, so usually a month. And so a statement of activities takes place over a period of time, whereas a statement of financial position is done at a specific point in time. So usually over a period of month, you would state your revenues, so income that has come in, and your expenses according to the three classifications of net assets described above. All right, so this is now like your income statement. You're classifying all the income that came in over the course of a month, all the money that went out over the course of the month, and that becomes your statement of activities. So we just saw the organization, Home for You, and we saw their statement of financial position. Now here is their statement of activities. So this is for the month ended, again, over the course of the whole month. Now they started on the 31st, so this keeps it nice and simple. And so here you see their revenues on the left, their revenues, their expenses, and then the change in net assets. And then you can see three columns plus the total. Unrestricted funds, temporarily restricted funds, permanently restricted funds, and then the total. Again, for most churches, nonprofits, you can get rid of that permanently restricted column. If you don't use it, lose it. And so here you see that the revenues, the contributions they had were unrestricted, were 10,000. They did not have any expenses in the month of January because they just opened on the last day. The change in net assets is that the assets went up 10,000. And so our ending net assets are 10,000, and then you carry some of those totals over. So total revenues for the month were 10,000, total expenses were 0, change in net assets were 10,000. Okay, so this is a very simple statement of activities based on one transaction that happened in 1 month for an organization that opened on the last day. So now let's get a little bit trickier. I would like for you to get out some paper. Hopefully you have some paper around you, and make the following chart. All right, I want you to, at the top, have assets equals liabilities plus net assets. And then underneath that, we will have transactions on the left. We're going to go through 5 transactions together. And then for our assets, you can see that there are 2 columns. So hopefully you're writing this out while I'm talking. I don't see you, so I don't know if you're doing that, but I'm hoping you are. Under our assets, we have 2 columns. The first is cash. That is one of the assets that we will track for this particular ministry. And then the next one we have is prepaid. And so those are the only 2 assets that they have. They could list inventory, they could list supplies, they could list equipment. But for this particular example, they're only going to use what they list what they actually use, and that is cash and prepaid assets. Then for liabilities, again, only 1 column. They have an accounts payable. That's it. They aren't taking any loans. They don't have any notes that they need to report on, so only 1 column for accounts payable. And then under net assets, we have 2 columns. We have our revenue, money that's coming in, and so donations or whatever, if they do service revenue. And then expenses is money that's going out. So the net assets are going to be the revenue minus the expenses. All right, so does everybody have their chart made? If a few people can just unmute and say yes, or tell me to wait for a second.
Yes.
Thank you. Okay. All right, I think I mostly heard yeses, so I'm going to proceed.
Excuse me, so the net asset is it revenue minus expenses?
It's revenue minus expenses, yeah, to come up with your net assets. All right. So let's go through these transactions. So the first transaction was the 10,000 that we received, and I'll show you that in a minute. You can copy that down, so don't worry. The first transaction we want to look at is now they opened on January 31st, right? And so now it's February 1st, it's the next day. And so they received this $10,000 donation, and now they're going to go and rent office space. They write a check for $2,000. And that check of $2,000 covers 2 things. It covers a security deposit of $1,000, all right? And so this company that they're renting from says that in case of any damage, you need to pay $1,000 and we'll hold that. And then they also paid their office rent of $1,000. So every month their office rent will be $1,000. So they cut a check for $2,000 to cover their security deposit and then the office rent. So on your sheet, you can have your first transaction listed as number 1. Yeah, that was the cash you received of $10,000, and that becomes a revenue, right? That's an income that came in of $10,000. And now we want to look at transaction number 2. So you wrote a check for $2,000, and that covers the security deposit of $1,000 plus the office rent of $1,000. So how do we write this in this particular spreadsheet? If anybody would like to unmute and tell me, that would be great.
I think the 1,000 rent will go to expenses.
Good. What else?
Same with the deposit.
Where does that go?
Expenses as well.
No, it's not an expense.
It's going to be prepaid.
Aha, it's going to be prepaid. Good. And what else gets impacted? So our prepaid shows $1,000 because it's a deposit. It's still our money and we'll get it back. It's an asset that we hold. Somebody else is holding it for us against, not against our will. We give them permission. The rent is the actual expense of $1,000. But what else changes in our financial position? How do we explain, how did we make that prepaid and pay for that expense?
I think cash has lost 2,000.
Excellent.
So yeah.
Cash goes down by 2,000. Very good. And so this one, maybe not fair on my part. It's a little tricky for your first one, but cash essentially goes down 2,000. And how do we explain where did that cash go? Well, 1,000 of it went to another asset. Somebody's holding on to it for us. And 1,000 of it can be explained by the fact that our expenses we had to pay 1,000, and so we always note expenses as a minus because it's something that's being subtracted. All right, and so cash also should have a plus or a minus. When income comes in, it's a plus. When money goes out, it's a minus. Good. Let's go to the next one. If you're not getting it, it takes practice, but let's keep going. Transaction 3.
Just a minute. How about the prepaid? I thought that is a minus. Why should it be?
No, the prepaid is still a plus because it's an asset that you're holding. And so somebody else is holding your money for you, but it still is an asset. But it left your cash, and that asset went from a cash asset to a prepaid asset, but it still is an asset. So cash went down, and then we explain that by our prepaid going up for 1,000. So sometimes the transactions can take place fully on the asset side, and in this case, it happens in both the prepaid as well as the expenses.
I think the problem is prepaid. When we talk prepaid, it's money you are actually going to spend, but here it's a deposit. So it's a security deposit that will return to you at some point. That's why it's still an asset.
Yeah, same with a scratch card that you pay. Yeah. All right, transaction number 3. On February 2, a $400 check is written to the utility as a one-time security deposit for electricity and heat service. All right, and so this is, again, a check is being written for a utility, but this is for a deposit. Again, it's a company that's saying, before I turn your electricity and your heat on, then you're going to have to pay $400 just in case you run away and don't want to pay the bill. When you are finished with us, we will give you that deposit back, assuming that you paid all your bills on time. And so some companies do require these types of deposits. And so, oops, I didn't mean to do that. So how, I thought I had the transaction.
I saw it. I saw it.
I saw it too.
I had it first. I did it first.
I knew it. I had the answer.
What is
What
there?
happens? What do we do with this?
What was right?
I had entered it.
Okay, so tell us what happens.
You put minus 400 under the cash and 400 under the prepaid.
All right, very good. So our cash, in this case, our cash just goes from one asset into another. So it's subtracted from our cash because, again, somebody else is holding it, but it still is our money. So if we decide to cancel our rent, we get our deposit back, and we can get our deposit back for the electricity and the insurance as well. Oh, there it is. See, I had it just reverse order for the animation. All right, next one. On February 19, the organization Home for You receives a contribution of $8,000 that the donor specifies must be used for the purchase of furniture. All right, and so the donor gives $8,000 to the ministry, and the donor says, I want you to buy furniture with this. So how do we classify this?
8,000
A liability, accounts payable.
revenue.
All right, 8,000 goes in revenue. Good, because it's a gift that we've received, right? What else changes? Because again, this is double entry bookkeeping, so it needs to be entered in.
Yeah,
It's got to go under the cash as well.
All right, very good. So cash goes up 8,000. I didn't trust myself that time. Cash goes up 8,000. And how do we explain this cash? Where did this asset come from? It came as a form of revenue. Now, if we are doing the statement of financial condition, what type of revenue is this? What type of asset?
Restricted.
Good, it's temporarily restricted. Temporarily restricted asset. All right, last one. And this time I want somebody else who hasn't spoken yet to answer. The electricity and heating invoice, now it's the end of the month, has not arrived. This is now an accrual system, okay? It is estimated that the amount for February's usage for the electricity and the heat was $350. So the following accrual adjusted entry is recorded on February 28th. So let me explain that. The accountant wants to acknowledge what's happened in February, and the reality is that in February, we estimate based on previous usage that our heat and our electricity bill is going to be $350. And so the accountant wants to enter that into February because that was when it was used, even though we haven't received the bill yet. So how does that get recorded?
I think we'll put it under accounts payable.
Excellent. Very good. And how do we explain that accounts payable? What is that? What did we get from that?
What it means is that it's money that we owe to an entity outside, which must be paid.
Right, but what did we get? So what did Home for You get that they now have to pay $350? We got how do we account for that liability?
Yeah, under prepaid, we would have negative 350.
No, it's not part of our deposit. It's part of our regular bill.
We have deposit of 400.
We have the deposit,
Yes.
but we don't touch that until we close down and we say we're out of here, we're leaving, we're moving. So where that deposit
So
isn't
it's
touched.
50.
All right, let me help. It's an expense, right? So the ministry has used electricity and it's an expense. We don't touch the deposit until we're all done. That they don't allow us to touch it until we are leaving the building, moving out. But it is an expense, and so we have to say that we have expenses as the ministry. This is a heating expense, $350, but we haven't paid it with cash yet, so it's an accounts payable. It's something that we will pay, but we haven't done it just yet. All right, and so so these are the 5 transactions that we want to take a look at. And when we add these all up now, we will see that we have 10,000 in cash. We subtract 2,000 for the deposit and our rent. We subtract 400 that we paid for the deposit on the electricity, and then we received a donation of 8,000. We have a total of 15,600 in our cash column. In our prepaid column, our assets, we still have 1,400 assets that are sitting in somebody else's hands. We don't have them, but there are assets. The accounts payable, we have a total of $350 that is owed in accounts payable. And then we also have a revenue. We show 2 different donations that were received, 10,000 and 8,000, a total of 18,000. And then for expenses, we paid 1,000 for rent, and we paid $350 for our electricity. Now, we paid it, but it's still now waiting in accounts payable for when we will actually pay that bill. When we actually pay that bill, we don't recognize it as an expense again. Our cash will go down, right? And we'll get rid of that liability. So when we add up our assets, the cash and the prepaid, it must equal our accounts payable, our revenue minus our expenses. And so if you take 15,600 and you add 1,400 to it, you get 17,000. And then the opposite part of the equation, the liabilities, is 350 plus the revenue of 18,000 minus the expenses of 1,350 gives you the same 17,000. And so it balances, okay? And so this is our essentially, when you do your transactions this way, it becomes very easy to do your statement of financial condition because you have your assets, you have your liabilities, you have your net assets right there. You can copy them over to your form. It also allows you to do your statement of activities. The revenue and the expenses is essentially your income statement or your statement of activities. What money came in, what money went out over a period of time. So let's go to that. If we look at that now, this is now the statement of financial position, better known by those of us who like the term balance sheet better. Here you can see that. So on your left, you see your assets. You have cash assets and you have security deposits, a total of 17,000. On the right, you have a liability. In this case, it's an expense that you need to pay, $350 for that electricity. Then here is where you see, oh, I took one out and I didn't adjust it here. Oh no, I didn't, sorry. Unrestricted net assets are of 8,650, temporarily restricted net assets of 8,000, total net assets of 16,650, plus that liability gives you 17,000, and the two sides match, all right? And so that's how you put together a statement of financial position. But here for owners, for managers, it's important that you understand how these numbers, where they come from, and how they need to be lining up. You need to understand how it is that our assets somehow equal either our liabilities or our net assets, and what are our unrestricted net assets and what are our temporarily restricted net assets. If we were to look at the statement of activities, which is like the income statement, we would lay it out in this way. So unrestricted funds, we received in this period. Now this is just for 1 month. Remember the 10,000 we received in January. So we didn't receive any unrestricted funds in February. We did receive 8,000 in temporarily restricted funds in February. And so our total received for the month is 8,000. Our expenses, our total expenses is 1,350, and that was for rent and electricity. Total expenses 1,350. Our change in net assets then, therefore our net assets went down in unrestricted by 1,350. We no longer have that in our unrestricted column. So our total unrestricted now is 8,650, 10,000 minus the 1,350. Our temporarily restricted, we just got this donation in for the furniture. Our change in net assets went up 8,000. And so in our temporarily restricted, we have 8,000 and we received nothing in this column. For a total of our unrestricted and our temporarily restricted is now 16,650. So I want you, I know we're not gonna be able to answer everybody's questions. So, but let's just unmute for a minute and either say yes for yes, I'm with you, or no, I'm lost. So unmute for a second and just shout out yes or no.
I'm with you.
Yes, I will be with you.
With you.
Somehow.
No.
Yeah,
I don't
somehow.
You want to ask a quick question?
Yeah, I don't understand why the total is 16,650 and not 17,000. I've lost.
Oh, that's good. Very good question. Thank you for that. And the reason is that statement of activities does not show the liability. So here we have an expense of 350, and it makes it look like we paid it, but on the balance sheet, on the statement of financial position, that's where we show the liability. Excellent question.
Okay. Yeah.
16,000. Thank you for that.
Thank you.
All right, I'm going to go on because we're terribly short on time. Statement of functional expenses. I'm going to really briefly go through this. This is if you want to charge every program a little percent of the rent of the administration. You could set up a budget if you do it that way, where you are charging, let's say you have a youth ministry and they use the church, right? They use the building, they use. Let's mute ourselves, please, or Emmeline, if you can help with that. And we are trying to, we are then allocating some of that rent to the youth program. We're telling the youth, okay, you are good at raising money. We want you to put that as part of your budget. And so we explain it in that way. You want to know more about that, we can talk about that at another time. I don't want to spend time on that. Statement of cash flows. And that's similar for the for-profit business. And so that's what you've been doing, is keeping track of your own cash flows, right? Your income coming in, your cash that's going out. You may have cash from financing as well. You may get cash in from a loan. You may have cash in that comes in from investments. So again, I'm not going to spend a lot of time because I actually want to look at an example of our homework from that, so that we can look at how cash management works. So let me stop sharing this for just a second. And I'm going to share now this. All right, and so in your assignment, so I had a student, I've taught this class for a while, and so here's just a sample. I took out any descriptive information of this person. This is the assignment that you had that is due today. Friday, excuse me. Many of you have turned it in already, and that's great. And this is the Excel document that you can find on the Google Classroom site. And here you can see that this is a simple cash journal, right? You're just listing in the total of what you spent over the course of time. So that you have the date, you have the description. Very important to start with your starting balance. And then what you spent on food, what you spent on gifts, what you spent on transport, and so on. All right, so that part is relatively easy. You're just entering it in. And then it's important at the bottom to get your total. What is the total income that you spent? And what is the total that you have in expenses? So here we see in this scenario that the income was $51,500. The expenses was $106,360. So we could say, how can that be? We have to look again at the starting balance. So the starting balance was $25,000. And we can see in this particular example that there is a deficit that is remaining here. So let's see if we can understand what happened a little closer. And now we go to the second tab, the analysis worksheet. On the analysis worksheet now, we take everything that happened, right? So we have a starting balance and then we have food, and we take every expense and we want to allocate it to one of these columns that are here. And so here we see food, $1,860. All right, we're going to put that in the food column. Then we have a gift. And so I love that this person is giving gifts to their wife, and we put that in a giving column. Now, you may have these different columns are going to look different based on your expenses. All right, you may have columns that you don't use, get rid of them. You may want to define gifts to the church. Here we have both tithes and offerings, and so this is giving just in general to other people. The next one is food, $23.50. And this is what's critical, because this is where I see a lot of mistakes happening. You notice that there's a space left between them, and that was because this gift was given here. You want to make sure, don't crowd them up, don't bunch them up, because on several of your assignments, I saw that you forgot to, the amounts didn't balance, and it was because you forgot to bring an expense over to one of your columns. All right, so you want to make sure that in every line there's an entry. So the next one is transport 30, then the next one is 500 for an offering, then the next one is food again, and so on, okay? And so just make sure that all of those expenses are lining up. And then here, of course, is where we find some balancing that happens. So we see income, $51,500, total expenses is still $106,360. This must equal all of these, all right? You want to allocate all of your expenses to one of the columns that you are working in. And again, you get to call the columns whatever you want, whatever makes sense for you. And so here you see that the sum of all of these equals this sum, okay, 106,360. If it doesn't equal, it usually means that you just forgot to move one of those numbers over, but you want them all to equal, because then you will take these totals and go to the next one, the analysis summary. And there's a very easy way that you can, if you want to find out, and here you can see that this person took a loan, and so that explains some of the deficit that didn't enter in on the income. It could have been entered in there. But one way to see, just by way of explaining this to make things easier, an Excel trick, if you want to know, well, how much did I spend on transport, you put in the equal sign, and then you go to the analysis worksheet and you say, okay, this is what I spent on transport. You click on that, you hit enter, and it's automatically entered there. All right, and so again, all of these now you're looking for the month of July for this person. This is what they spent on food, so $19,710. For the month of August, they spent $37,760. And so this gets to be a running summary for every month, assuming you keep doing this, and we hope that you do, for September and October and November. And then you want to see the family, when I'm setting up my budget, wow, I spent a lot more in August than I did in July on food. Was it because there was a birthday? Were there other celebrations? Do I like that? Was there something wrong with my spending? Was there something wrong with the budget? How do I look at that? And so again, you want to make sure that these are all matching. And then you take it to the last tab, which is your income and your expenditure account. All right, and so this is like your statement of activities. You have your income that's entered in. So they had gifts that they received. They had a loan that they received for a total amount of income of $73,000. And then you can see what they spent on transport and on food, on offerings, on phone, on giving, gifts, or on other things like a miscellaneous column, for a total of $106,360. And then they take their income, they subtract their expenses, they have a deficit of $33,360. But their cash that they came in with was $25,000. And so we again subtract the income over the expenditures, and we see a negative balance of $8,360. So we don't know how this person spent money that they didn't have. That would be a question that we'd want to go back and ask them. But you can see that in this way, all of these 4 documents tie in together. Now you could really do this on one. The analysis worksheet could have all of your transactions and then the breakout columns, that's fine. But having the summary so that you can see month to month how you're doing is important. And then to be able to put it into an income statement, you may or may not do that all the time for yourself, for your ministry. This is what you would give the congregation. This is what you would give the board members or the stakeholders of your ministry if they want to see how much income came in, what were these expenses for, and how are we doing overall. That's what you want to be able to give to them. So that is the hope, that you are going to be able to turn that in. I'm going to stop sharing here. And if you like, I can send you a sample to look at, to see, especially for the formulas. Excel is wonderful. You know, adding things up on your own, there's just a lot of human error that happens with that. So use those formulas to your